Hello everyone, my name is Sky. Today I would like to present the topic Financial Institutions, Definition and Types. To be able to understand what is a financial institution, we need to understand what is a company. By looking at the transaction a company engaged in, we have two common types of company. One is trading companies, another is manufacturing companies. Trading companies engage in buying products from one party and then selling them to another party. Manufacturing companies engage in buying materials to manufacture finished goods and then selling the finished goods to the market. So it can be seen that a company engaged in the transaction of buying and selling of goods. For financial institution, so it is just a specialized company. It engaged in the transactions of buying and selling funds. Let's have a look at a brief balance sheet of a financial institution. The liabilities and equity side shows how a financial institution raises funds. That means buy funds. The asset side shows how a financial institution use funds. That means sell funds. A financial institution can raise funds by accepting deposits, issuing certificate of deposits, issuing debt securities, issuing equity or others. And it can use funds by making loans, invest in debt securities, or invest in equity securities and other. The question is, from which units a financial institution can raise funds? So it can raise funds from units with surplus of funds and then use funds for units with shortage of funds. In an economy, we have households and company. Tell me which one tends to have a shortage of funds and which one tends to have a surplus of funds. So we know that households tend to have a surplus of funds, while companies tend to have a shortage of funds because companies usually have a project to invest in but don't have money to do the project. While households don't have a project to put their money into, but they have money. So by raising funds and then using funds, financial institution has fulfilled the function of generating funds from units with a surplus of funds, usually households, to units with a shortage of funds, usually companies. So that's it about what a financial institution is. Let's move on to the types of financial institutions. In the US, financial institutions can be categorized into two groups: depository institutions and non-depository institutions. The difference is depository and non-depository. So depository institutions are institutions which are allowed to accept customers' deposits. Non-depository institutions are institutions which are not allowed to accept customer deposits. So in this case, they need to rely on issuing debt security and equity security to raise funds. So examples of depository institutions are commercial banks, saving institutions, and credit unions. Nowadays, there is not very clear difference across the three types of financial institutions. But in the old days, saving institutions specialized in residential mortgages, and credit unions specialized in small consumer loans. Examples of non-depository institutions are insurance companies, security firms, investment banks, investment funds, finance companies. The difference between securities firms and investment banks is security firms offer services which assist the trading of existing securities. Investment banks provide services which assist the trading of new securities. So if a company wants to do an IPO, IPO stands for initial public offering. So that means the share of this company initially offered to the public. So this is new security. So in this case, this company should go to an investment bank to get the service which assists the IPO. However, so let's say investor buy these new securities 6 months after they need cash. So they need to sell the securities they are holding. So these securities are existing securities, they are not new securities. So in this case, investor should go to security firms to get the service which assist them to sell these existing securities to the public. So that's the classification of financial institution in the US. So let's see how is financial institution classification in Australia. So if you open the website of the Central Bank of Australia, you can see financial institutions are categorized into 3 groups. The first one is authorized deposit-taking institution. So actually, they are the same as depository institution in the US. The second one is non-authorized deposit-taking institution. And the third one is insurer and fund managers. So actually, the second one and the third one are non-depository institutions in the US. Example of authorized deposit-taking institutions are banks, building societies, and credit unions. So actually, building society provide similar services to the saving banks in the US. Examples of non-authorized deposit-taking institutions are money market corporations, finance companies, securitizer. Examples of insurers and funds managers are life insurance companies, general insurance companies, health insurance companies, superannuation and approved deposit funds, public unit trusts, cash management trusts, common funds, and friendly society. So if you're looking at the column total assets across these types of financial institutions, so you can see that the total assets of commercial banks is many times bigger than the total assets of other types of financial institutions. And actually, it accounts for 47.11% of the total assets of all the financial institutions in 2016. In Singapore, we have banks, we have Asian currency units. So actually, Asian currency units also belong to banks. They are just the units which process transactions in Asian currency. We have finance companies, we have merchant banks, we have insurance companies, insurance brokers, representative office, and international money brokers. And this table presents the total assets of these types of financial institutions in Singapore between 2011 and 2015. And again, it can be seen that the total assets of commercial banks is many times bigger than the total assets of other types of financial institutions. So what I want you to understand is the commercial bank plays a very crucial role in stimulating the growth of an economy. Okay, the last part is let's do a quiz. Number 1, which type of financial institution is the most common type of financial institution? Commercial banks, saving banks, investment banks, or credit unions? Which one? Commercial bank. Because the total asset of commercial banks is many times bigger than total assets of other types of financial institutions. Number 2, which financial institution rely more on short-term and long-term debt? Commercial banks, saving banks, finance company, credit unions. So it can be seen that commercial banks, saving banks, and credit unions are depository institutions. So that means they are allowed to accept customer deposits, while a finance company is a non-depository institution. So it's not allowed to take deposits. So that means it needs to rely on short-term and long-term debt to raise funds. So the answer here is C. Number 3, which types of financial institutions specialize in residential mortgage and consumer loans respectively? So we know that saving banks specialize in residential mortgage and credit unions specialize in consumer loans. So the answer here is B. And the last one, which financial institution engage in assisting the trading of existing securities? So we know investment banks and security companies involve assisting the trading of securities. However, investment banks involved with assisting the trading of new securities, while the security companies involved with assisting the trading of existing securities. So the answer here is D. Okay, so that's all for today's topic. Thank you for watching, and please support my project by subscribe, share, and like. Thank you, and bye-bye.